Welcome to the Gorman Trubitt Dealership Controllers Roundtable webinar series. Like many other live events, due to the COVID-19 concerns, our June Dealership Controllers Roundtable in Dallas has been shifted to a virtual event. We know how you depend on our dealer-specific CPE-eligible educational training, and we are excited that we can continue to offer you more than 8 hours of informational sessions over the summer and into the fall. We will kick off our Dealership Controllers Roundtable webinar series with our first roundtable, COVID-19 Catalyst for Change and Affirmation of the Model, brought to you by Truist Bank, formerly BB&T and SunTrust, and Gorman Trubitt. This presentation focuses on the buy-sell environment for dealerships. It was recorded live as a Zoom webinar on May 28, 2020, and all information was accurate and up to date at that time. If you have any questions regarding this webinar or future CRT webinars, please feel free to email us at askus@lgt-cpa.com and we will get back to you as soon as possible.
Good morning and welcome to our first virtual Controllers Roundtable. For those of you who don't know me, I'm Patrick Riley, a partner at LGT, the firm here, with a specialization in car dealerships. This year marks LGT's 70th year. We are a full-service CPA firm based in Dallas, Texas, serving both Texas and the Southwest. Our dealership practice, which is headed up by Colin Kanalakis and myself, is LGT's largest niche, where we serve over 300 rooftops, our franchise, independent, heavy-duty trucks, RV, and motorcycle dealerships throughout Texas and the country. LGT has been putting on these controller roundtables once or twice a year for over 20 years, where we give dealership-specific CPE to controllers and owners. Unfortunately, with the current situation, we were forced to cancel our scheduled June Controllers Roundtable in Dallas. So instead, we're planning on doing these monthly mini roundtables like today. Along with that, we've been having PPP loan seminars, which I know is a hot topic for everyone. And we plan to continue having those as more and more guidance comes out. So stay tuned to your emails for upcoming events. Please let me or Reed know if there's any specific topics you would like us to cover on these. As of now, we're still planning on having the Controllers Roundtable October 22nd and 23rd in person at the Mocara Hotel in San Antonio. And with that, I'll turn it over to Reed, who is one of the principals in our firm. Go ahead, Reed.
I'm Reed Crow. I'm a principal with LGT. I've been with LGT for a little over 11 years, and I spend about 100% of my time in our dealerships services group. And I'm really excited to kind of present today's speakers. Our first presentation will be from David Stevens, Head of Dealer Commercial Services at Truist. David is heading up the integration of BB&T and SunTrust auto dealer finance practices, which consists of bankers 100% dedicated to serving dealers across the entire Truist footprint. After that, we'll have Brandon Artigue and Greg Langhoff, who are part of the Financial Risk Management Group at SunTrust Robinson Humphrey, the Securities Underwriting and M&A Advisory Services arm of Truist. Brandon has client coverage for the entire commercial dealer services specialty group, working with the clients to hedge interest rate risk. Greg is the team leader for the state of Florida. He is responsible for all hedging, such as swaps for working capital, mortgage-related obligations, and dealer floor plans in Florida. Then lastly, we'll have James Taylor, or JT, Managing Director of Automotive at SunTrust Robinson Humphrey. He and his team advise on mergers and acquisitions and strategic planning for auto dealers across the entire nation. I also want to give a quick shout out to Chad Lovell, Stuart Will, and Brett Hotchkins. These are the dealer service bankers covering the state of Texas for Truist. We wouldn't have this great lineup of speakers today without their partnership, and we greatly appreciate their involvement in Controllers Roundtable. With that, I'm going to turn things over to David.
Well, I'm thrilled to be with you today. I'd rather be in Texas in person, but these are unusual times. Let me tell you a little bit about what I want to cover this morning. I want to give you just a quick update on BB&T SunTrust, now Truist. I'll tell you a little bit about our dealer commercial business, our response to COVID-19, And then really the meat of it is more around what we're hearing from dealers and a couple of client outreach initiatives we have going on. And then a bit on the auto industry globally and the consumer outlook. And a lot of that will set up JT Taylor for the latter part of this session. So I'll launch in now on the second slide, which is just a view of our purpose. As I said earlier, SunTrust or Truist is a combination of BB&T and SunTrust. We're a purpose-driven company, and it's been amazing to see how similar our two organizations were as we came together really 6 months ago. And our purpose is to inspire and build better lives and communities. Next slide, Katie. Thank you. Just a few stats on the bank. We're the 6th largest bank in the country now, number 2 in deposits in the top 20 MSAs across the US. We have 12 million households as clients and have over 58,000 teammates. So big is important, and particularly in the world we're in today, it allows you to invest in technology. But what really makes our company, our new company, special, I believe, is a community banking region-based model that we run, and that really makes us distinctive and different from our competitors. Our company was quick to react to the COVID-19 crisis, and I'll just walk you through some of the things we did from focusing on clients, communities, and teammates. That was the way we triaged this crisis and continue to deal with it. From a client perspective, significant support to our clients via special programs, cashback offers, fee waivers, and payment deferrals. We're also a major player in the Paycheck Protection Program, or PPP, and provided in round one over $10 billion of loans to 32,000 companies, and we believe protected over 1 million jobs. From a community perspective, we launched LGT Cares to meet the short-term and long-term needs of the community. And we just doubled that commitment. This slide, and this shows you how fast things are changing. I think this slide shows 25 million, and just yesterday we announced we're doubling that to 50 million. And the focus of LGT Cares is around technology and devices being provided to underserved communities, aid to small businesses via access to capital and technology, and then support to nonprofits for the communities we live and work in. So that's a little bit about what our company's doing, and we'll switch to the next slide. I'll talk a little bit about our dealer business globally. There's a lot on this slide. I'm not going to go all the way around this wheel. I'll just hit some of the high spots for you. First, Truist, a combination of BB&T and SunTrust, is extremely committed to the dealer business from a commercial perspective, from an indirect perspective, and from an investment banking perspective. We're committed to it, and we want to grow this business. It's a big part of our company, and we want to continue to grow it. What really makes this business distinctive is the connectivity and our partnership among the 3 key areas. JT runs the investment banking practice. I run the commercial banking practice, and Bill Jones runs the retail indirect program, which is a full spectrum program. The 3 of us are wet at the hip. We're equally yoked. We have very similar philosophies, and we actually like and care about each other. And I would say that I think that's very different from a number of our other competitors. We're very connected. In addition to that, what makes our group different is we connect this through our commercial community bank partnership with the regions, and we give it a local feel. So that's a little bit about our model. I'll tell you a little bit about what we did for COVID-19 relief as it relates to our dealers. First, the initial program focused around floor plan credit facilities. We provided 90-day deferrals on curtailment and floor plan interest. We gave some more aggressive terms on aged units we would allow to be floored, and we relaxed the repayment terms when vehicles were sold. On the term credit facilities, we provided 90-day term loan P&I deferrals. And we did similar programs on consumers, providing extensions and deferrals on the indirect retail program. And as I said earlier, our company and from a dealer perspective, we're major players in the Paycheck Protection Program for all of our clients, smallest to the largest. And the majority of our dealers were participated in and were taken care of in the Paycheck Protection Program through Truist. In addition to the dealer relief programs and the Paycheck Protection Program, we also have launched a client outreach initiative, and we've really tried to ramp up or turn up the volume on our content. Throughout the crisis, we've been in frequent communication with our dealer clients, and this client outreach initiative I'm talking about, will touch every dealer in our client by the second week of June. What it's done is given us tremendous insights into the strength, the resilience, the ingenuity of our dealer client base. And I'll tell you a little bit more about that in a minute. From a content perspective, we ramped up industry related content. I'll give you 4 examples. JT Taylor and SunTrust Robinson Humphrey, our investment bank, produced a wonderful paper that's gotten a lot of attention and positive feedback on automotive retail COVID-19 market update. We just have kicked off a What's Driving Your Business 4-part series podcast. It'll be released shortly. We recorded 2 of the 4 sessions and we'll finish the other 2 next week. Our McGriff Insurance partners have produced a very meaningful paper on COVID-19 reopening best practices. And then our investment bank continues to provide auto retail equity coverage and industry updates. So client outreach, industry updates and contents are a big part of what we're doing. Let me talk a little bit about what we've heard in our client outreach initiative. And again, this will touch every dealer in our portfolio. The focus was on their response to COVID-19, and then we wanted to understand the action steps they've taken, the results it had driven, and what it looked like for them from an outlook perspective. And then we also spent time at the end of the call talking about products, ideas, and solutions that might help them navigate this economic crisis. So here's what we're hearing from our dealers based on this outreach initiative. And we've had over 200 conversations today. First, the impact varied wildly depending on the region you operate in. Texas was impacted, obviously, but nowhere near the level of impact of, say, a California dealer or a New England dealer or even a Pennsylvania dealer. So it varied widely by region. What we knew going in, but got validation of coming out, was that we have experienced management teams that know how to manage through a crisis. The majority of our dealers took decisive and quick action. They furloughed staff, they reduced variable expenses, but they paid careful attention to make sure they maintained their tech staff and their service areas. They participated in deferral programs, but not out of a sense of financials, that they were in financial trouble, but as an insurance policy. They have an intense focus on cash management and cash position. They've begun executing digital and online virtual programs, as well as things like contactless sales, service, and delivery models. And that's in various stages depending on the dealer. They leaned in on data to drive the sales process and have more successful hits. They clearly focused on grosses and making sure they were as profitable as possible on every deal. And then they thoughtfully implemented COVID-19 social distancing and other client teammate safety programs. So dealers were busy. The short-term results that we've seen, most of our dealers have remained profitable and cash flow positive during this crisis. I participated in a number of these calls from California to Hickory, North Carolina to New England to Florida to Maryland. And I just heard some great stories about dealers that were actually potentially more profitable than they were for the same months last year because of the significant expense management steps they've taken. But they're profitable. They've built huge cash balances, and they're beginning to hire back staff as their areas open up and their sales volumes pick back up. What we're hearing from a concern or current concern perspective from our dealer clients is that they're laser focused on PPP forgiveness and managing through that process. They're very concerned about their ability to get new car inventory. They're worried about used car prices, the health of the consumer, and a potential second bite at the apple on the COVID-19, from a COVID-19 crisis perspective. Next slide, I'll talk a little bit about what we're seeing from an industry, overall industry outlook. And I call this a game of industry and economic whack-a-mole. You solve one problem over here and you whack it down, and another problem pops up somewhere else. So that's really what we're doing. And we're getting quite skilled at being quick to react to problems and whack them down as fast as possible. But our industry's dealing with significant economic and other issues right now. The speed of change is immediate and having an immediate impact on our sector. We're trying to figure out how quickly sales will bounce back. We believe they'll bounce back in the second half of the year, but how fast that happens is to be determined. The SAR projections are all over the place right now. You see a low of 12 million-ish, a high of 16.5 million. Most of that ramped up on the backside or second half of the year. But anyway, you slice that, that's a 15 to 25% decline, and that'll be material. OEM plant closures have certainly had an impact on new car inventory. If you think about where we were at the peak of this, every plant in the U.S. was shut down, 43 total. And I think another 29 in Mexico and Canada was shut down. So even though most of them are opening back up or already open, the production capacity will be dramatically reduced. And if you've seen some of the schematics on how they're having to do manufacturing process in this in this COVID world we live in, it's going to not be as productive as it used to be. We're looking at and considering the impact on used car prices at things like the rental car agencies dumping a number of units in the market might have. The decline in vehicle miles traveled could be an issue. That's going to be a service impact. If you look at me, I generally drive 2,500 to 3,500 miles a month. I'm on the road a lot and flying under normal times. So every 6 weeks I'd be into the dealership for an oil change, tire rotation, and some other service. Well, it's been almost 3 months since I've been in to have service. So that will impact dealers as vehicles mile travel go down. And then there's clearly going to be an impact short-term on multiples. JT will dig in on that later, but it's certainly going to also drive up consolidation. So all of these somewhat negative things also, though, create an opportunity in what I call a time of crisis. You're going to see dramatic changes in business models, both from a manufacturer to the dealership level. I suspect you'll see an increase in OEM mergers and alliance. I spent some time the other day looking at alliances and how they've ebbed and flowed over the years. And I believe this will be a time where we start to see more partnerships evolve, and we've already seen some of that. The manufacturing process will be reimagined. Dealerships will become more efficient and crisper in expense management and other processes. The digital consumer experience will pick up a head of steam, and things like the pausing on rideshare and public transportation that'll happen will drive future sales to our business. And then we'll see once in a lifetime acquisition opportunities coming up. So last slide I'll end up with is just a little bit about what's going on with the consumer. Without the consumer, we don't have a business. So they're really important to us. And there's some staggering statistics on the challenging side of this equation, but then there are also some seeds of hope I'll touch on. You know, those unemployment numbers are moving all over the place. As of this morning, so my number on this slide I did a few days ago is already dated. As of this morning, we're down to 14.5%, but we got as high as 17.2%, and that number was the highest we've seen in the last 80 years. We have 20 million people still on unemployment today, but the number of people that have been on unemployment during this crisis has been as high as 40 million. We've had declines in income, both base pay and incentives. Consumer sentiment has dropped from 97 down to 72-ish. And then we've seen some indication that consumers are going to pull back on their car purchases until they see how this thing settles out. So those are the things that work against us. But the seeds of hope, I believe, that will help us manage through this is our government has provided massive stimulus and pumped money back into the economy, to the consumer, to the businesses, via things like stimulus checks, the CARES Act, Paycheck Protection Program, and coming down the road, Main Street and other programs. So these programs have given job security. They provided consumers and businesses with cushions to weather the storm, and they will help us. Our industry has stepped up. I'm really proud of Truist. But I'm also proud of how our industry has stepped up. I served last year as a chairman of the North Carolina Bankers Association, and banks across the country, captives across the country have stepped up proactively to help our dealer community and help all our clients. And I think that's just something we all should be proud of. The industry is providing incentives, and our industry has a history. Auto dealers, the folks in the room today or on this call or video conference, have a history of leading our company out of an economic downturn. So I believe our industry will lead our country out of this downturn. I'm optimistic about the second half of the year. We still have some challenges to manage through, but I believe there will be crisis-driven innovation that will help us all be better as business people and leaders and entrepreneurs, and it will be a net positive for us in the long run. But we still have a ways to go. So Katie, those are my comments, and I'll tee it up for Brandon and Greg to talk about the interest rate environment.
Okay, as we move into the next slides, talking about kind of an overview of the interest rate market, the oil markets, and then some things that we're seeing from a financing perspective. I'm Greg Langhoff. As mentioned, I have been covering the dealer markets for over 10 years with SunTrust, now Truist. You know, I sit in Florida and have been covering the Florida markets, but also had the national footprint for the dealer group under SunTrust, and have transitioned to a new role as Truist came about. So Brandon has taken over that coverage on my behalf. So I'm going to turn it over to him to give a little brief introduction of himself, and then we'll dive into the material.
Thanks, Greg. So my name is Brandon Artigue. As Greg mentioned, I am responsible for dealer coverage on the interest rate risk management side for Truist, and specifically under SunTrust Robinson Humphrey, which is the investment banking arm under the Truist umbrella. So I think slides 2 will be our disclaimer if we want to go to the next one. And then the next couple are brief bios of myself and Greg, which we can skip through. And we'll start jumping in with an update on the interest rate market. What you see here is a 5-year Treasury yield and a 10-year Treasury yield since over the past 12 months. And what you'll see, obviously, is that things were already moving in a downward trajectory in 2019. Then COVID hit, and things really accelerated, and rates fell off a cliff. So what we're showing here is that both medium as the 5-year rate and long-term rates, the 10-year rate on the government yields have declined. Right now, the 10-year yield's about 70 basis points. The last time we were anywhere near here was back prior to the 2016 election, in which case the 10-year was about 130 to 140. So we're set new lows and significantly lower than where we've been any time historically at that. If you actually stretch this graph back a little bit further, what you'll see is that the 10-year actually peaked at around 3.25 in November of 2018. So basically within a 2-year time frame, we're talking about nearing 300 basis points in decline for a 10-year rate. So very volatile, to say the least, but with that volatility comes opportunity for our dealers and our clients to lock in either medium or long-term financing for their businesses going forward. This slide is aimed at showing the impact from coronavirus specifically across various interest rate and credit markets. So I'll start at the top left. What you'll see here is, if you want to focus on the light blue line, that is the Fed funds rate. And what you'll see is that in March, so early March, the Fed cut 50 basis points. That's the first stair step lower for the overnight rate. And then in a matter of weeks, the Fed cut all the way to 0. That's that second larger step. And we've been there ever since. So we went from a Fed funds target rate of 150 all the way down now to 0 to 25 basis points. So extreme measures have been taken by the central bank. But what you'll notice is that the 1-month LIBOR line, which is the dark blue one, did stay elevated for some amount of time, even though the Fed cut the overnight rate to 0. And so again, if you'll take a look at that darker blue line, notice how it even went up after the Fed's announcement that rates were cut to 0. That was a sign of distress in the market. So it symbolizes that funding between banks was not robust. As you might imagine, the Fed continued to step in and provide more liquidity to the banking market to help ease those concerns and calm down that volatility. So for example, looking at where we were on April 1st, LIBOR was around 1%, even though the Fed's overnight rate was basically 0. Since then, you'll see that the blue line has calmed down a little bit and come back down to where that light blue line is. And I'd say that that's a good sign, just because it means that, again, things in the funding market have calmed down. In normal times, you'll notice that the blue line will be, the dark blue line will be ahead or higher than the light blue line, just because it's a 1-month rate versus an overnight rate. So where we are today, 1-month LIBOR is 17 basis points. The Fed funds rate is 5 basis points. That feels about normal, which is, again, all of this is to say that it's a more conductive environment for lending for banks. If we'll go to the bottom left-hand slide, this is the forward curve for 1-month LIBOR. So you'll see, again, today it's around 17 basis points. And for the next 2 years, it's not really expected, at least not in the market, to budge much, and then start to normalize and head higher in years 3 through 7. So this is the market's expectation for what LIBOR will do over the next 7 years. And, the takeaway here is obviously that the Fed will probably remain where we're at today for an extended period of time in order to see the recovery through, and then begin to normalize some point in the future. This changes a lot, so this isn't static. Any inflation expectations with all of the money printing that's been going on could certainly change this and change it pretty quickly. For instance, if you just pulled this forward curve from a point in March, it would have looked completely different. So that's not to say that this is what's going to happen, but just that this is what the market is projecting as of this moment. And then the last graph I'll hit on here is on the top right. So we talked a little bit about the Fed funds rate and LIBOR and how they've both come down since the onset of COVID-19. But one thing to note is that in the credit markets, what we can do is we can look at credit default swaps, not to necessarily understand them, but just to take a holistic view of where risk premiums are trading in the market. And what you'll see is whether you look at the HY-CDX, which is the high yield credit default swap index, or the IG, the investment grade CDX, both of these have basically doubled since everything began to unfold. And so again, it's not necessarily important that you understand the hows or the whys of the credit default swaps themselves, but it's the takeaway is that the credit markets, the premiums, the risk premiums that banks are willing to lend have all meaningfully widened out. So I did talk about how government rates have gone to zero, but it's important to note that the spreads that the banks will lend at, or any lender for that matter will lend at, have certainly risen because of the uncertainty going on with demand and in the economy in general. And with that, I'll pass it over to Greg for any last comments on this slide and moving on to the next one.
I appreciate it, Brandon. And, not much really to add there. It's interesting to look at that forward curve and think that a couple years out, the market does put some expectation on some Fed movement, but waiting to see what happens. Obviously, the shape of this recovery will certainly dictate what happens with that yield curve going forward. As we think about moving on to the next slide, when you think about your businesses, being the dealer side, we certainly understand how the price of oil, the price of diesel dictates your consumers' behaviors. So you think back, you guys certainly remember the times when gasoline prices were rising. Seems like the large SUV vehicles were being turned over for the more fuel efficient, and as soon as that market turned back around, the consumer was back to looking to buy those larger SUVs. Obviously many of you guys being in Texas certainly understand this market as well as anybody. But when we think about things that are going to drive this market going forward and then how that impacts the consumer, we kind of think of the things that are on that right-hand side as to, will we see solid demand growth again? David mentioned it earlier. He's one that's usually on the road a significant amount. High demand in these last 2.5 months. We've all been basically quarantined to the house. Therefore, the demand for gasoline has certainly fallen. And with that, you're seeing the prices fall as well. A big piece of this, though, does have to do with, geopolitical issues that are in the world. Our conflict with Iran, what's happening from Iran's perspective, Venezuela as well, certainly drive the market as a whole. And then just, as the prices come down to the point that we're seeing at this point in time, I know a lot of the refinery here in the United States is based upon, or the extraction is based upon fracking. And as we get to, the prices dropping, it almost doesn't become economical for them to be doing that. So they pull those wells out of the ground. So how that drives supply certainly is a big piece of something to pay attention to. As we mentioned earlier, inventories are kind of, you think about what OPEC's done, they've made an agreement to cut that supply. Unfortunately, their track record isn't the greatest to actually follow through with some of those agreements, especially as demand picks up over time. So even though it is a gradual taper back up, we'll see kind of what happens as we get later this year and certainly into 2021. One quick thought about going back to from the rates perspective as well, which also drives this, the oil markets was, later this year, we do have an election. Thinking about what happened from a market perspective on all sides after the election 4 years ago, we certainly saw a significant increase. And will we see something like that again, depending upon the outcome of that election? So, with this, I'll kind of turn it back over to Brandon to run through, what's the next step for LIBOR.
Thanks, Greg. And another really important topic for business owners to understand is the transition of LIBOR, or I should say the phase out or sunset of LIBOR. Back in 2017, a lot of regulators came out and they made some fanfare saying that LIBOR is not a good index to use for loans, and we're going to move to something better. And now here we are some 3 years later nearly, and it still doesn't feel entirely like we're going to be able to hit the target, which was the end of 2021. But nonetheless, understanding where we are and what this transition means for your business is something that we wanted to hit on. So LIBOR stands for the London Interbank Offered Rate. It's a short-term, often a 1-month short-term interest rate. And it's often the index that banks will use to lend against floor plan or real estate that would reset in theory every month to get what the loan's actual rate is. So the problems with LIBOR, which you can see in the middle of this arrow, would be reported rigging. SunTrust, BB&T, Nor Truist are part of the LIBOR calculation. So this was with respect to banks that were submitting LIBOR resets in London. There's low volume in the actual market, and so it's a little bit strange in that the index is based off of a theoretical loan, and very low volumes of that theoretical loan actually happen. And so that was the impetus for getting this new index. The new index seems to be SOFR. So SOFR stands for the Secured Overnight Financing Rate. It is actually based on transactions that are happening, and a lot of them at that. So there's a lot of volume that drives the SOFR calculation, and therefore it's a lot less susceptible to being rigged. So that's a little bit about the background of LIBOR and why it's being transitioned to SOFR. If we want to move to the next slide, this is a little bit of a compare and contrast between the two. I'll focus on a couple that I think are interesting for business owners to think about, and that's the interest convention and the payment convention. So I'll start with LIBOR. You'll see it says set in advance, and then the payment convention is made in arrears. So that is a huge convenience for our dealer clients, because what it means is if you close a loan, say here on today's May 28th, let's say you close a loan on June 1st, the first payment would be in most cases on July 1st. And so what you would actually know is on the very first day, on June 1st, you would know the 1-month LIBOR reset, and therefore you would know exactly what your payment is for July 1st. So it sets in advance, but the payment happens in arrears. So you know what the rate's going to be, you know what the payment's going to be a month ahead of time. However, given that SOFR, I did mention that it's the secured overnight, given that it's a 1-day rate, you actually don't know what 1 month SOFR is going to be until you go through the entire month and average up each business day's close of SOFR. So I'll say that again, the interest convention is based on an average over the course of the month, and then you'll usually have a delayed payment, for instance, a couple days, since the last observation in my hypothetical example would be on June 30th. So there are definite positives to switching to SOFR, and again, the regulators view it as less susceptible to manipulation and the other things that I mentioned. But one of the downsides compared to LIBOR is that for business owners that will use SOFR going forward, for the month of June, for instance, you'll have to average each individual day's reset. And then you wouldn't know what it would be, the final payment that is, until the very end of the month. And you might end up having to delay the payment to July 3rd, for instance. So that's a very important topic with respect to any new loans going forward. I guess Greg and I will take a pause there. We hit a little bit on the market, then commodities and how that could drive consumer demand, and then finally LIBOR to SOFR transition. If there's no questions, I'll pass it back over to Katie and to JT. Thank you all for your time.
I'm JT Taylor. I am a managing director for the automotive practice at SunTrust Robinson Humphrey. There is a lot to talk about today, but we're not necessarily going to spend a lot of time on a lot of text that is in this presentation, but I do encourage you to download your copy of it and go through it at your leisure. But it's we've got a good team at SunTrust Robinson Humphrey on the automotive side, and we stay very, very focused on automotive retail. From the standpoint of personal experience, I've sat in your seat as a dealer principal, general manager, and owner of car dealerships, and it was a great experience, the hardest work I ever put in my life, but the most fruitful experiences, and I think we all know that it's a very rewarding business for those of us that are able to execute well. And execution definitely has been tested over the past 12 weeks. Congratulations on weathering it rather well. As David Stevens has pointed out, we're getting great feedback from our clients throughout our footprint of 19 states. And it's when you reach out to 800 rooftops and get feedback, you can expect some pretty varied answers. But the consistencies of how well you have managed your risk in this time has been very, very impressive. And let's go to the next page real quick. We're going to talk about M&A trends in automotive retail. That's why, buy sells, what's going on, where are the values, and as a function of a little bit of education, we're going to talk about what we look at as the components of valuation. How do we come up with a market price for a dealership when in either you're purchasing or selling that asset? And then section 3, we'll cross over a little bit on what David Stevens started off today and update the market and the various things that we're seeing, some of the data trends. If you can go to the next slide, Katie. That's my picture. Yeah, but it's this is narrative, and I'd ask you to read it. But the most important part of it is the next to the last paragraph. And if you'd transition there, Katie, so I can read that more clearly. I believe car dealers will once again prove their excellence and lead the U.S. into a remarkable season of prosperity. Coupled with the support of partnering manufacturers, lenders, investors, vendors, and even the federal government, recovery will be a reality. We will look and act differently. It's called progress. Auto dealers have established the auto retail sector as a linchpin element for prosperity in the U.S., and we'll all benefit from their success as they earn this recovery. My belief is that automobile dealers are the fabric of American entrepreneurial culture. Incredible community, civic, family-minded people who own these dealerships, maintain incredible partnerships over very sophisticated businesses. This summary is going to give you a picture of what we're going to talk about today. What happened right away? The initial effects of COVID-19 on retail. We'll talk about the material decline in year-to-date share price performance of the public automotive retailers. And we look at them as an indication of the overall health, not because of they're better at it or they're worse at it, but because they typically have national footprints and they report their information on a regular basis out to the public and their shareholders. And we can do some analysis on that. Considerations for the auto retail M&A environment, we're going to step into that. What's going on with the wholesale market and used cars, that behind the scenes fuel that keeps our trades happening. How financing captives are increasing their share, but what's going on with those consumer loans? What direction do we expect them to go? Our OEM partners, what these restarts mean, what can happen to them because of supply chain disruptions. And then we're going to talk about points of focus on a moving forward basis. Let's go back up to the top. You can go back. Sorry about that, Katie. The material decline in year-to-date share price performance. Here is an indication of how the equity markets look at our business. The S&P 500 as of Monday was off 8.5% from its on a year-to-date basis. Franchise automotive retail dealers, there's 6 of them in the public world, they're off 26%. Used auto retailers, CarMax, Carvana, et cetera, who are public, they're off 4%. And the automotive OEMs, God bless them, the markets hate them, they're off 36.2%. Let's go in and step right into what's going on in the trends in M&A. A sharp reversal from high public market valuations and transaction momentum. Expectations were really high for the industry going into 2020, but a lot of trends that we were experiencing in the first 9 weeks of the year have been completely reversed. Second half of 2019, blue sky multiples, what you would have to, that amount that you would have to pay in a premium for a dealership over asset value was just continued to rise because business was very good. And we were getting better and better in a thriving economy. Private dealerships were really growing well, but here's what happens today. Public auto retailers who were driving a huge anticipation of transaction activity in 2020, it's going to be very difficult for them to trade. We talk about their shares trade on a trough multiple on trough earnings. That means they get a lower multiple on lower earnings when things like this happen that we just gone through. The graph on the upper right-hand side shows that fourth quarter of 2019, market high for their multiples for the public companies, 6.6 times their earnings. Rapid decline by the middle of May, down to 3.3x. Public companies were anticipating about $2 billion worth of transaction activity, which was activity level that we hadn't seen in over 5 years. $2 billion, and most of those deals have been canceled or put on hold for the foreseeable future. We'll talk about why in a couple of minutes. Transactions, that's the number of deals that we track and see happening. That's probably going to be cut in half. Buyer-seller disconnect because of the volatility. Brandon mentioned the uncertainty and how banks kind of react to that uncertain economic environment. Well, likewise, transactions, whether it's selling or buying. And what we have is a bid-ask spread. That means, sellers are still, it's fresh. This was a short period of time, 11, 12 weeks, and things were going great. So my value of my business that I'm selling should still be strong, right? Well, buyers are a little more focused on what's going to happen in the future. And they can't draw a clear picture of that yet today. When you take a look at the, activity of the valuations, public companies, they're pretty much out of the market. They can't do what they call an accretive acquisition. When they're trading at 3.3 times their own earnings, they're not going to pay the 4.5 to 5 or 6 times earnings that a private dealer commands today. So private dealers are going to trade amongst themselves at best, which is why we're also forecasting that there'll be a significant drop in transactions. Automotive retail sector price performance versus the S&P. We talked about this pretty much, but this is a little more graphic demonstration of it. Interesting, and I think everybody on the call understands this. The used business is once again proving its resilience. Economic downturns, we all lean in and count on that gross profit from used vehicles, and the demand increases for used vehicles as a percentage of the buying population. Banks typically are supportive of those transactions at the consumer level, and it's part of the resiliency of our great business model. Let's go to the next slide. The big companies just telling us in no uncertain terms, back in business timing is putting their plans on hold. It doesn't matter if you're, our big competitors down there in Houston, Group 1, who have stores all throughout the Southwest and Southeast and Texas. Carvana, even with their very interesting to the market business model and the things that they're doing, really difficult. And then Penske, arguably one of the best managed car groups in the nation, just have put everything on hold because institutionally, the memories are pretty good of what happened to us in 08 and 09. Everyone's going through the same situation though globally, and we're having to make hard decisions, just like Asbury had to when they had to back away from the acquisition of those fabulous Park Place dealerships in Dallas, Fort Worth, and Houston. It was a wonderful acquisition for Asbury. It was a wonderful price that the shareholders of Park Place were able to get. Amazing transaction, really setting the tone for how the year was going to go. And this was a keystone acquisition for Asbury. Board of directors and the senior management team at Asbury made the hard decision, wrote a very substantial check for liquidated damages back to the seller, $10 million, another $6 million in fees, swallowed that because they were going through the same things we all were. Focus on their existing businesses, maintain the cash flows as best we can, protect our clients, protect our people, and then get back into business as the market allows. Hard decisions, and it was particularly disappointing, I think, for everybody involved in that. They're not the only ones. This happened to be the one that was the largest scale that got terminated. Interesting page. The SAR has been performing better than everybody anticipated. The graph, the line chart that's on the upper right-hand corner, actual versus estimated monthly annualized SAR. The anticipation for the SAR, this chart was developed on March 25th. Think about that. And in the darkest days, frankly, of what was going on in retail. Anticipated a 3.3 million unit SAR. Came in 8.6. We're like 5.2 was the forecast for May, 5.2 million units. It's likely to approach 10, maybe 11 million. A rate that we didn't say was going to happen until we got up into September. So the pundits the prognosticators that were saying, oh, we're going to see a U-shaped recovery, they're not in the car business, folks. And they're not paying attention to how our customers have reacted in the past. When folks go back to work, they buy a car. And that's just the way it's worked forever. It's one of the wonderful things about what drives America, and it's literally our businesses. Will we see a 15 to 16 million SAR by the end of the year? Likely. Will we get to a 16 million total SAR? I don't know. There's a lot of different things that could affect that. David touched on a few. We'll talk about a few more. But when you look at the bottom, since 1990 and 2019, these are the numbers that recessionary periods and the percentage change in volume during those periods. Recession proof? No. Recession resistant? Used cars? Definitely. Parts and service? Definitely. And then new cars, a lead indicator is the performance of new vehicle sales. This is more for your edification And for those of us in this presentation, this is more for investors who aren't necessarily as familiar of our business and its resiliency in downturns and its performance. You can see that even in economic downturns, with the wonderful variable expense model that we do have in our businesses, we're able to keep a healthy balance of used to new and vehicle sales to service and parts, gross profit, and margins typically increase in the recession. It's a puzzlement for the general public. They think when new car sales tank, we tank. Well, it's a struggle, no question. But we're able to react in ways that our business model has been structured to give us fruitful activity and still drive margins. And in this case, margin increases. Let's go to the next page. Consolidation. David touched on it a little bit. One of the things that we've been looking for in the car business is there's going to be a decline in the number of owners of car dealerships, and it's going to be significant. Well, I can tell you, as a former dealer and as someone who's paid close attention to this because of how we make our living today in the car business, dealership owners are exiting at a pretty steady rate. The negative compounded annual growth rate since 2012 through 2018 and 19, we just got our data for that, is about a negative 2%. So we consolidate the number of owners by about 2% every year. Now, our friends at Cox Automotive, they believe that we're going to go from 7,500 owners today. It's a little bit more than that, about 7,500 owners in 2019, down to 1,000 in the next 15 years. That trend is probably inaccurate. We anticipate that trend is going to be somewhere between today's steady 2% consolidation and what the Cox folks are prognosticating on what they think is going to drive it. And there are some key things that are going to keep it from going that fast. Let's go to the next page. It is ripe for consolidation. There's no question. The number one thing that's going to contribute to consolidation accelerating over the current 2% change a year is outside capital. That screen that I showed you that shows how well we do in a recessionary period from a margin basis and from a revenue basis, and how do we adjust our business model in order to maintain profitability in tough times was a surprise to a lot of folks. But now they're getting it. There's more private equity that's gotten in the business. There's a couple of large groups there in Dallas, one called RML, another one called RFJ, great companies that have used outside capital to come in and fund growth. And they've had a great experience. Well, now other private equity and family offices who have lots of capital to invest are paying attention to our franchise dealer model. Here's really where it's going to go. There's 7,500 franchise dealer owners in the United States. They own 18,314 locations, rooftops. Those rooftops have 32,100 individual franchises. Since 2013, about 1.5% of the franchises have traded annually. That's about 225 transactions. 480 has been the run rate, and it's year in, year out. This year's going to be a hiccup. We anticipated it was going to be substantially higher this year. It's going to be substantially lower. But that is probably an ignition switch to drive this greater acceleration. The number of U.S. dealership buy-sells trend is smaller groups, there's fewer. Bigger groups since 2011, up 75%, 6 to 10. Those that are more than 11 stores is up 82%. Scale is important in our business. This is just what we call these tombstones, which is sad, but that's just the nomenclature that investment bankers use. These mementos of transactions show you that since 2014, there's been a considerable amount of big activity and big dealer groups from some really savvy investors out there who have taken positions in large automotive dealership groups. Let's go to the next page. So when they make a decision about what they're going to buy, or when a seller wants to know what's my deal worth and what's the market for this point, a valuation exercise is a very, very strong first step. Here's how SunTrust, Robinson Humphrey, and a lot of the market look at valuation from a market standpoint. There's 6 things that drive value: the brand, the market that we're in, the management team that's driving the results, the facility that we operate in, the presence, that's how we go to market, advertising, digital platforms, reputation, and then of course the big one, the historical and opportunistic performance of the dealership. Real estate, goodwill, assets. That's what we value. Assets, we'll talk about how that's valued. We'll talk about how retail is valued by buyers. And then we'll spend a little more time on this multiple of goodwill. What will increase a multiple? Metro markets are more valuable than rural markets. Rapidly growing markets, Austin put itself on the map in the last 15 years, and it's extraordinary growth. And the values of dealerships down there have gone up incredibly in value. Low tax markets, read Texas. Low real estate costs, relatively speaking, read Texas. Geography well suited to the franchise. We'll talk a little bit more about that. I'll give you an example now. A Toyota store in the Woodlands in Houston that makes $2 million a year is worth more than a Toyota dealership making $2 million a year in the northern suburbs of Detroit. Why is that? Well, more consumers in Houston want to buy a Toyota than they do in Detroit. So the upside is significantly larger. The value, the geography drives an increased value in that franchise. The management team, and particularly if they're successful, is going to stay in place when we transact. Or if it's a good brand in a good market and is significantly underperforming, the multiple of the existing earnings is going to be pretty high. What drives it down? Over-dealered markets. There's a couple in Texas that have a few too many of something, and we can go through that some other time. Dealerships not being marketed properly. Just like used cars, a well-reconditioned, right-priced, suitable for the market vehicle is going to turn faster and for a higher gross profit when presented by a professional who is ready to present the value of that business. Or it can just move fast it can sit, linger, not reconditioned, not being treated with the right level of attention from the sales team. And typically you'll hear, "If I could, would you?" being the approach to that vehicle. Same way with the dealership. And it puzzles me sometimes why a dealer, the shareholders, would take a look at these multi-million-dollar valued businesses and hire somebody that's going to run a print ad in the back of automotive news to get traffic, or go through their Rolodex and just have that exact same phraseology I used. "If I could get this deal for you at this price, would you take it?" That's not marketing it properly. Facility issues. If you haven't done the upgrades that are required by the brand, they're going to reduce your blue sky. Rural areas do trade at a lower multiple to metro areas. Slower negative growth markets, transitional markets. Interestingly, in Texas, you got oil patch. When things are great in the oil patch, dealerships go for a premium. When things are, on their face, which they have been, it's very difficult to get a great value for that dealership. High tax states, not your concern. Add points that may be announced in a market. I've been doing really well, but oh my goodness, they're going to put a Honda store in Grapevine right next to mine in Dallas. That lowers the value of the existing store. High real estate costs, no matter what. That's always going to drive down your multiple. Let's go to the next page, Katie. Real estate, it can be the most significant portion of an auto dealership valuation. In the metro markets, definitely huge consideration. The real estate valuation is a composite average of both the buyer's and the seller's appraisal. Buyer gets an appraisal, seller gets an appraisal, you meet somewhere in the middle. You don't have to sell the real estate. You can keep it, lease it, or you can, if you're leasing it today, you can sublet it. Most likely you can sublet it to your buyer and maybe make a margin if you negotiated a great lease. Real estate that's leased and owned by a third party typically is not included in the valuation. Location, just like any other, it's any other piece of commercial real estate. It's where it is relative to the traffic that's necessary to make that business thrive. Additional variables, what could that property be used otherwise? Once again, the right kind of traffic and high traffic counts, and the surrounding population. Is it growing? Is it shrinking? Are the economics of my neighborhood match up well with my brand? Facilities that do not comply with the manufacturing branding standards will be discounted in goodwill value. Most buyers who are buying a store that has not been upgraded to standard will take an estimate of what it's going to take to upgrade that facility and deduct your good value on their first offer, dollar for dollar. So if your goodwill value for your dealership is $6 million and you've got $1.5 million worth of upgrades that have not been done that are necessary for that the manufacturer is going to require the buyer to do, they're going to reduce their goodwill by $1.5 million to 4.5. Negotiating around that, maybe, but typically it's pretty hard and fast. Deferred capital expenditures are almost always a reduction in blue sky value. Let's go to the next page. Net assets. New vehicles, used vehicles, parts, and fixed assets. In new vehicles, almost never included in valuation. However, there is likely to be a ding in a per unit, on a unit by unit valuation if they're not current model years. So if you've got a bunch of 2020s on the lot when the 21s are coming, it's likely you're going to be offered a discount for those 20s. Used vehicles, almost always included as what we call the working capital of the dealership. Valuation of all or part of the used inventory is always a point of negotiation. It's just, nobody looks at the same vehicle the same way. Typically what you see is both parties agree on a reputable valuing source, and then they go unit by unit and make sure that they match up. Always includes owned company vehicles in those used vehicle valuations. So rental fleets, etc. Parts inventory, it's basically any inventories that we have, parts, oil, and grease that you're using on a regular basis. Aged or obsolete parts, just don't even count them. They're going to have little or no value. Your non-automotive merchandise, unless you have an extraordinary retail parts manager and a retail parts center that really generates some significant gross profit, almost always that merchandise has little to no value. Fixed assets, typically is depreciated book value. That's furniture and fixtures, computer equipment, whatever you've got it on the books for is what's going to be paid. Some buyers will mark it up because of certain states or the way they approach their taxes, but that's rare. Sometimes we see service department equipment and tools, particularly in a newer store or a freshened store, they may be subject to an appraised value. Goodwill. This is the big deal. It's, the industry has generally accepted multiples vary between manufacturers. The multiples are published in various automotive publications. We keep a private one that we use for our credit team to analyze risk. The multiple is used with either pre-tax earnings or adjusted EBITDA of the location. A lot of times goodwill is the largest component of valuation. Some M&A people use discounted cash flows. So those of you that are familiar with DCF, you know that it's really not applicable to our business. Let's talk about the variations. You won't hear me say anything disparaging about Cadillac's products. I think they're excellent. The market value of a Cadillac store is significantly different than some of their competitors. Porsche happens to be the most valuable franchise out there. And there's a considerable spread, even though a Cadillac store may be able to produce the same number of unit sales, the relative goodwill of a Cadillac store is significantly lower than a Porsche store. What can change the multiple? It's usually stable, but when large OEM issues such as a bad product lineup, incentives or lack thereof, or scandals, the Volkswagen Dieselgate. We'll see some other things. We're going to talk a little bit more about the risk involved in product lineups here in the future and how that's going to affect brand value. Nothing affects brand value more than gain or loss of market share. So if you've got a brand in your market that is just not performing well, overall, it's likely in a decreasing value standpoint. Keep this one. This is a pretty current picture. We took this picture as in February. This is what we see on the deals that we financed at Truist, that other ones that we have market knowledge of, and then the deals that we've been able to get identified that were done by the publics. So it's a nice database that we have, and we're able to back into what we see people paying as the goodwill multiples by brand. These are national averages. National averages. Interesting to look at. Pick out your brands there along the bottom. You can see where they're going. I'm going to give you a Texas example. A Chevrolet store in where there's not too many Chevrolet stores in the market in Texas is worth as much as a Toyota store. Think about that. Very market specific. And it blows this chart out of the water. But that's specific, but that's, once again, this is where you end up with when you're dealing with national averages.
Sorry, just to add to that a little bit, if you go back one page, one of the questions that kind of intrigues me when I see this chart, and maybe you can add to it a little bit, is I was a little surprised to see, even though it says it's declining Audi, I was a little surprised to see it as high. And then also, do you have any comments about Volkswagen and it being steady?
If we had taken the same picture, Patrick, last year, you would have seen that it was its last year of decline. Volkswagen is one of those franchises that is kind of steady state in its attitude in the marketplace. The consumers typically have a higher value impression of Volkswagen than the dealers. I'm not a Volkswagen dealer, Patrick, but Volkswagen as a brand has had difficult dealer relationships since 1975, and they don't get any better. That's what keeps their value there, and it's also what keeps the investment, I think, lower. Now, Audi, oh my goodness, 11 different car lines in the luxury market, aggressive product plans, very dealer specific, they're luxury, but dealer specific lease programs that have margin in them. A nice package. Audi went down only because there are some key markets where they may have one or two dealers too many compared to their competition. So once again, the snapshot that we take of these national values, there's a lot of factors that take it up or down. But it doesn't really go up or down a lot unless something really bad happens. Volkswagen has recovered to where they are now. It was in the red for quite a while. It was lower than that. They went green last year, and now they're at a steady state. But a good question.
Yeah, okay. Those are just two that kind of stuck out at me. I appreciate the feedback on those.
Not a problem.
Sorry to put you on the spot.
That's okay. That's okay. Hopefully some Volkswagen and Audi dealers on the call. Investors' expected return. This is really why, this is how investors look at our business. What is my return on investment in the first year based upon my purchase price? So if I put X number of dollars in this business, what am I going to get back in first year returns for an annual return on investment? A tier 1 franchise, the expectation is going to be somewhere between 10 and 20%. And those brands up there regularly provide year in, year out, those types of returns for the people that buy them, and they get better from there. They pay a premium for these brands, and they have for a long time. Subaru is a new arrival into tier 1 in the last couple of years, but for all the right reasons. Those of you that are Subaru dealers probably recognize that they've made great improvements in their product lineup, faithful to their brand imaging. When they did ask for a new building, they didn't ask for a Taj Mahal like some of the people in tier 3. And consistent. So the consistent behavior of these brands allow them to get a premium. Luxury is always going to have some premium attached to it because of the perceived value. There's a vanity value to having a luxury mark for a lot of dealers, but these are the ones that get the premium. Tier 2, Steady Eddies, Chevy, Ford have been in there for decades, right there. Expected returns. Some Ford dealerships and Chevy dealerships triple those returns, based upon how they perform in specific markets. Jaguar, Land Rover, two brands that for a long time struggled. Together, they're okay, but man, that Land Rover franchise is just outstanding. And Jaguar is building much better products. They probably could break into tier 1 if they didn't have such a unreasonable approach to market representation and facilities. Tier 3, the ROI's got to be higher than 25%. And that affects how much my purchase price is going to be. There's the folks that are in there today. Asset value. There's a couple of 3s that are approaching going down to asset value. There are some different places where these brands do better. We have a client in the Northeast that makes almost $2 million a year with his mini store and a standalone mini store. Just does a great job. The Maserati dealer here in Fort Lauderdale, where I am, does a great job. But if you got a Fiat store, just give it back. There's no value to that. It's hard, to say the least. Genesis is likely to break into tier 3 based upon what we've seen and how they're approaching the market. And they are funded by one of a low-cost producer and one of the largest manufacturing concerns in the world. So we'll see long-term what their strategy is. That's how investors are looking at it. Adjustments. EBITDA adjustments that buyers will recognize and say yes. Rent. Rent adjustment is calculated by taking a composite cap rate and the nearby geography. If your value of the property is $2 million and you're charging a cap rate that is market, then you're going to get $2 million and it appraises for $2 million, you'll get that. If the property appraises, and that's what you're charging in rent, no adjustment. If you charge too little rent to the dealership, you're going to get an adjustment the wrong direction to your earnings. If you're charging too much, it'll be added back to your earnings. Owner's salary. Shareholders typically don't stay around, and so that we get to add that back. Some bonuses that are paid and how they're structured. If it's above market, they're going to get added back. Proceeds from reinsurance companies, if they are off statement, like a lot of you do have them, and that's great business to have those, you can expect about 60 to 80% of the value of that to be credited back to you. As you know, when you start a reinsurance company, it takes time to get to a place where it starts paying premium back to you. And everybody has to go through that. The great thing about the reinsurance company, if you do take a discount on its value, is you still get to earn that out. It's yours. Shareholders' personal expenses, we all put some, that's one of the benefits of ownership, and anything that wouldn't be put through there normally is going to get added back. Any overrides that go off statement, if I sell a service contract and I get $100 credit to my account that is held off statement, separate from my reinsurance company, or I'm paying that out to somebody else, that gets added back also. Management fees. If you've got a management company and the store's paying $200 a retail, $400 a retail, 2% of the gross, whatever it might be every month, that management fee is going to be added back. Any PACs that are not, there could be some live adjustments on your operating statement for those PACs. And then LIFO and FIFO adjustments are made. Here's an example bridge at the bottom. We start off with $6 million in EBITDA for 2019. We were undercharging ourselves in rent. Our reinsurance business is 60% of the value is $500,000 a year, goes back in. We put $50,000 a month in personal expenses through. There was a one-time inventory write-down that's not going to reoccur. And then there's some SG&A adjustments that we might make on the basis of those bonuses, et cetera, that are not market. And we end up with a $7.7 million adjusted EBITDA. Any adjustments are going to be subject to due diligence. And your team at LGT can help you verify those before you ever put them into a valuation. They'll tell you what is going to pass due diligence or not. They're your best filter. Coronavirus. Is there going to be an adjustment for this time period? We say yes. Sellers are going to go ahead and adjust it. The underlying aspects of Blue Sky value didn't change. You didn't change your brand. You didn't change your location. Your facilities are still stand up. You got a great management team in place. You've got a great digital presence, and you've got all the tools necessary to keep a great reputation in the marketplace. The only thing that was affected, and it affected everybody, was the performance. Now, once you are back on track, it is likely that you choose to sell the dealership in the next 6 to 9 months. We believe most buyers are going to look at and say, "How'd you do?" And you're going to be able to tell them, "This is how we did." And everybody's going to nod their head and say, "Okay, how are you doing now?" And when you show them the trend of your improvement or recovery from what happened in the shutdowns, that's going to get discounted. It will not be we don't believe it will be part of the calculation. So is Blue Sky going to go down? Only because of an uncertain future. And the more certainty you can prove in your future of how you've operated the business since in the recovery period will minimize that. This is how it all comes together. We've got somewhere between a 5.5, based upon the Blue Sky value for that 7.7 million, we've got somewhere between a 5.5 and a 7 times multiple based on my brand. It's a Honda store in Houston. So it commands 42 to 53 million in Blue Sky. We've got a big facility. It's brand newer. 30.4 million was the appraisal. Our purchase net assets, that's our used car inventory, parts inventory, and our furniture, fixture, and equipment, 4.3. Our total enterprise value, the purchase price, is going to be between $83.3 and $76.8 million for the business that we just described. That's how you bring it together. take a look at this. Any questions about this in the future, we answer for free. We love helping you walk through these things. And for truest clients, at any time, we'll do a market valuation. And we love doing it in conjunction with the LGT folks. Patrick.
JT, we do have one or two questions that have come up here. When you're referencing back to rents, is there a reference people can use to look at market cap rates?
Your local CBRE folks will tell you right away what a commercial rent rate is for your market. Coldwell Banker Real Estate. Anybody who's dealing actively in commercial real estate can give you a nice picture for what retail businesses are charging themselves or what the market is for those rents. That's we also contact the people at Capital Automotive in McLean, Virginia. They're the largest automotive REIT, and it was they openly will give you market information about your market, and they'll give you a range of what it is.
Do you have any concerns about the service side that we're seeing on dealerships currently? We've kind of had we're dealing with this unprecedented change where all of a sudden everyone's commutes are shorter, less people are on the road. We're slowly starting to get back. But what are you seeing as far as the service side and what that might do to some of these valuations?
Well, the gross profit generated in service and parts obviously is the highest margin business that we do in our businesses. So any change to that is going to affect valuation because in the end, it affects your EBITDA, right? So what we are seeing so far and the results that we're getting back is that best case, fixed operation run rates are about 85% a guide. That is changing every day as people get back in there. It's, maintenance can only be deferred so much. Your comment though about fewer miles driven, that's time will tell. Time will tell. I mean, we all have to look at, in professional services, how many of those folks are going to be, doing the David Stevens Roadshow all the time. It's likely it's going to lessen up because we're going to have more of these interactions like we're doing now. Not that we find them to be particularly attractive, but they are efficient. And those kind of things, we'll see how that plays out. Comment that I heard from someone though is when you can't fly, you hit the road. Vacation season's coming. It's going to be. We'll see what the miles driven are in there.
And then one more just popped up that says, "What's your opinion on the effect on dealership profits if the retail industry pushes hard to internet-driven retail?" We've got this. A lot of these, especially in Texas. Luckily, the dealerships were deemed essential, so they were open, but a lot of the push was for a lot more sales to be done through the internet, a lot less face-to-face interactions. How do you feel that might affect those dealership profits going forward?
Early indications are when you get past the distress level of sales, for example, the wholesale value of our vehicles on our used car lot dropped appreciably during this downturn. And we had a lot of overvalued used cars and we needed to blow them out because we didn't want to take the hit at wholesale. When you get past the distress portion of it, digital transactions are proving to be, on average, more profitable on a per transaction basis. The gross is higher. Shockingly, we just got some data last week that F&I income on transactions that are completed most thoroughly on a digital platform and the customer has a chance to self-select F&I products, the margin's higher than it is face-to-face. Now, that's no slam on, I will never speak disparagingly of a good F&I manager. They set the stage for that relationship and the good ones do it very well, and they sell products that people will need and use, and hopefully they get a great value for it. That value is very important. But left to their own devices, consumers tend to select more than they're presented at the end of a negotiation in the store. And I'll tell you, Patrick, the efficiencies are coming, but they're not there yet, because I want to talk about a couple of these on the market update.
Oh, sorry.
That's okay. That's all right. We're going to get to it a little more fulsomely.
I will say a quick note on some of that is we're working with some of our clients on the PPPL loan and trying to figure out employee-wise and stuff like that. We're actually seeing a number of our dealers that are doing well right now and realizing that they might be selling slightly less number-wise of vehicles, but they're not needing 15 people standing on their lot like they used to.
Yeah.
And I don't know what that trend's going forward, if they cut down that relationship and figure out how to work more efficiently, but it's an interesting change we're seeing. Agreed.
And we'll see more. As the tools get better, we'll do a better job with them. You guys look at your audit team looks at the expensive side on the operating companies very closely. And so often I would hear the question from my peers or from our clients, I'm spending all this money on technology. When's it going to start saving me some money? Well, the truth of the matter is, Patrick, Mr. Dealer, when are you going to change your processes so that the technology can give you some efficiencies? That's one of the difficult answers that people are going to have to come up with here in the next few years. Am I on board to change my processes and use these tools that customers seem to be wanting to use more of? Or am I going to stick to my guns and, we're going to have a very traditional formatted, get them under the tent and treat them like kings and queens and make it all happen here in my facility? It's an incredibly difficult balance that retailers are going to face over the next few years in these investments. Wholesale, this is a big deal. The wholesale segment, it froze. The base case, used vehicle prices are in jeopardy. It's true. Overall pricing, as of last week, was off about 17% from the beginning, from where it was expected to be. So the short-term used vehicle value projections were going down faster than what we would have had pre-COVID. As a matter of fact, used car values were really good pre-COVID and pretty steady, and that was a good thing because we had a lot of off-lease vehicles coming. Our captives and our lenders were going to be in a position to market those aggressively to us on the wholesale side and not take any losses. Well, they're going to take some big hits on some of these off-lease vehicles in the short term. Because look at the lower left-hand corner. Wholesale auction volume is approaching week by week where we expected it to be. The top line, the orange line, was what we thought in thousands of wholesale auction volume versus where it really ended up being. And it's likely by the end of the month, next month of June, it may surpass it because of pent-up demand and some availability coming from some unexpected sources. Our rental car companies are likely to be forced to liquidate bigger portions of their fleet. There's some interesting plays that are coming out there. We'll see how that goes. But expect to have a great number of late model used cars that are pretty attractive. This year, the anticipation was, Patrick, that we were going to get a slug of SUVs and pickups off lease nationally, which is what people were buying new. So the late model used business was something we were all looking forward to on the basis of what was coming back to market. They're still coming back. Price is going to be a little bit different. I think I saw a question there earlier, and I'll lay an opinion. If wholesale prices for off-lease vehicles start to don't recover the way that it looks like they will, manufacturers will put CPO programs in place. They've got to protect those residual values. If they recover, even with Hertz and Avis Budget dumping a lot of cars, they won't. They won't be any different than they are today. So that's my opinion about certified pre-owned incentives from the manufacturers. Indirect lending, the captives started off jamming. They really kind of protected us the best they could in April, and if you week by week, the long-term loan value, those 84-month 0%, even deferred payments on long-term loan values took a huge share of the business. The week ending March 29, 20 and April 5th, 22% of all new vehicle deals went to these longer-term loan volumes. Now, our company will tell you that, and we've been very active in 84-month financing at low interest rates to great credit customers for quite a while. Matter of fact, one of the leaders in the super prime and prime end of that. And we see those buyers perform very much like our 72-month and 66-month buyers. So it's not really a burden for the future. They trade very frequently. And you can see, though, the recovery as shorter terms, leasing comes back, and now we think it'll be back by the end of June, back in that 6 to 7% range of overall business. Captives, they jumped up and took a huge piece of the business. That's starting to balance off also. End of the year, we're going to see incentives like you've never seen before, both in financing and on what I call it trunk money, like a lot of you do. We'll see it'll be a great year to buy a new car. Restarting production. It's happening. David alluded to it. It was a massive shutdown in North America. We weren't bringing any vehicles in. You have seen your reduction in your lots, most certainly. We've seen it in our portfolio, our floor plan portfolio. Lowest it's gone in a long time, faster than we anticipated, certainly, because sales stayed pretty good. But we weren't building and shipping any new vehicles. Well, that's turning back on. As long as the supply chain can not take any unexpected damages, we will see it come back online. Is it going to affect the summer? Maybe. General Motors is probably, from what we're being told, it's a little bit more at risk on the truck and SUV side than their domestic competitors. We're already being told that, the Mercedes-Benz facility in Mississippi, the BMW facility in Spartanburg, South Carolina, they're going to be at full production by the middle of June. It's coming back, and it's coming back fast. Seeking capital. Ford went to the market to protect their capital position and raised $8.5 billion in a bond offering. And they did it at pricing that was much higher than double what they would have considered getting it 8 weeks before. Those kind of things are going to make it a little difficult to be aggressive on financing. So don't expect Ford Credit to jump up and have a lot of great deals. But Ford itself, I think, is healthy, and they will be big competitors here at the end of the year, and they're going to look for a big finish. Uncontrollables and unpredictables will make the third and fourth quarters of 2020 interesting. Lesson learned from all this time period, this last 12 weeks, flexible tactics are critical in being part of a recovery and maintaining your value. You got to be nimble. I would have to say that there's been a number of days that you guys have woken up and you think to yourself, yesterday felt like a week, and this week has felt like a month. But we're looking out the other side. Blessedly, you are in Texas. It's a great place to do business. You've got the citizens of Texas are very close to their vehicles and their commutes. It's a great opportunity state for car dealers, and I think it will continue to be so. The key considerations, these are the question marks that are going to keep people from making commitments on big purchases. I'm not talking about consumers. I'm talking about M&A activity in dealerships before the end of the year. The pace that Americans are going back to work are going to determine the pace of recovery and consumer confidence. Consumer confidence has to be high for lenders to be engaged, for dealers to want to take that risk to get another business or to sell their business. The cadence of recovery is going to vary by geography, making a national fiscal policy impact difficult to manage. There's some unintended consequences of these stimulus packages. For example, unemployment benefits that are greater than lost wages. It's hard to get somebody to come back to work when they're going to take a $300 a week pay cut. And that has to be reconciled. We got to figure those out. Operating costs are going to increase because of our necessary healthy environment compliance. We don't want a rebound issue with this virus, with anything like this. Let's do the right thing. It's going to cost some money. OEM's depleted cash reserves on the impact on product development will affect the competitiveness of brands. That is the number one thing on this page that you take away and you put it in your drawer and you check on a regular basis. Announcements like, this was pre-COVID, but it's very telling. General Motors is going to build the drivetrain and platforms for Honda's electric vehicles that they're going to start marketing here in the next few years. Honda dealers are some of our best clients. But if I had walked into a select Honda dealer 15 years ago and I say, General Motors is going to start building your cars, they would have just laughed me out of their office. But it's the reality of what manufacturers are facing today. It is very difficult to maintain a competitive and profitable product lineup that consumers want today and be developing these new technologies that are being driven into the OEMs, electric vehicles, active safety and autonomous driving. It's very expensive. So how do I develop vehicles for the future that are going to be remarkably different than the cars I'm building today? It's a balancing act that balance sheets are really going to be stressed, and you need to pay attention. The first place that you need to look is when they stop freshening an overaged vehicle, when they say that we're eliminating models for efficiency. I guarantee you they are making really hard decisions about their product lineups. Changes in product lineups are risky because it can affect market share. And remember what I said earlier about the key thing that drives a brand's value are changes in market share. You asked about digital retailing. It's going to happen, and it's expensive. And you're going to have to maintain sales and service processes that operate just like they did 3 years ago, and that we've gotten really good at, the in-store sticks and bricks experience. But then we're gonna have to have tools and people that are equipped to be really good at a virtual experience. We've got to do both. Can I give you a little inside baseball on one of your used car competitors, Carvana, which seems to be kind of a darling of the press and of the market? The average number of human touches, either in person, on the phone, or by email, on a purchase through Carvana is 14. That means Carvana, a person or persons that work for Carvana, touch the customer who takes delivery either personally, on the phone, or through email 14 times on average. It's still being developed. Nobody that that has taken delivery of a vehicle does it without having some type of human interaction. And we're going to need to have products and people, tools and people that make that to be a seamless process. And we got to do both ways. Brand values for domestic brands, I think they're going up here in the short term. Their product lineups are what people want. They went through the right sizing of the number of stores out there. The imaging requirements are reasonable, and domestic brands are getting a little bit more traction. Metro markets may experience a decreased value of commercial real estate. That's something to stay on top of for your shareholders. You've got to understand what are the underlying values of my real estate. And then after about a quarter of value adjustments, we think late model pre-owned vehicles sales are going to increase because of the lineup that's coming. It's going to be a great year for used cars. Are dealers going to make as much money as what they could have made in 2020? No. But is it still going to be a great year? Yes. And we think it'll be a great year in comparison of some recent years. Keep at it. Dealers are doing the right things. We are so impressed with your nimbleness and your willingness to do the right thing time after time for your customers, for your teammates, and for your shareholders. Thanks for your time.
All right, thank you. Well, with that, we appreciate you guys, SunTrust and Truist and BB&T, giving your time today to give some really great information. Thank you all very much for attending. Like I said, we're going to be trying to put a different mini CRT together every month. So we will be planning one in June. With the new guidance that came out on the PPPL loan on the 22nd, I imagine that we will be putting together a new webinar for that as well. One of the additional services LGT has started this year is a consulting on the PPPL loan forgiveness application. That's a mouthful, but if you need help with your loan application and what expenses go in or the calculation for, that is something that we are able to help you with. So contact me, Reed, or Colin, and we can help you take care of what you need. Everyone stay safe, stay sane, as you could hear my kids screaming in the background, and hope to see you all in person soon. Thanks again for joining us.
Thank you for joining us. To stay up to date on all of the webinars for this series, please make sure to follow our CRT page for more information. The link is in the description below, along with other important links, including our social media. If you want to see future Lane Gorman Trubitt Dealership Controllers Roundtable webinar series, subscribe and hit the bell icon for notifications.